Welcome to Bluehive Information Session. Today we are going to talk about ownership structures, and I'm here today with Rick Sndero from Sydney Tax Accounting Partners. Welcome, Rick.
Hi, Jonathan. How are you today?
Good, thank you. We know that property can be held in different structures, personal names, trusts. They're probably the main two. Let's talk about why, and let's talk more about investment properties because I think that's a good topic. Why would people buy property in a trust for investment properties?
Yeah, people have got many options on how to acquire or purchase property, namely investment property, in Australia for varying reasons. Okay, so the simplest way and the most common form of property ownership and investment property ownership, whether it's residential, commercial, or industrial, is to purchase in your own individual name. People undertake this exercise purely because it's simple, easier to get finance. They can wrap their head around it. They understand, yep, I own that property. Any income I make from that property, I pay tax on. Any deductions on that property after rent, we get to a net income position. This is also equivalent to owning a property in joint names with whether it's with your partner or whether it's with a sibling. There's various forms of ownership. With negative gearing, it can be attractive if you're on PAYG income. The way that negative gearing currently works is we receive rent from the investment property. We apply all our expenditure against that rental income, including interest. And if we've actually made a loss in terms of where we're funding that property, we're able to claim that negative geared loss in our appropriate income tax return in the proportion of ownership.
And therefore reducing the marginal tax that you would pay.
That's right. Also in an individual's name, and I commonly say in a joint name as well, we also get the 50% capital gains tax concession if the property is held for more than 12 months. And that basically means once the asset's been held for 12 months and then you decide to sell it for whatever reason, you do not pay your marginal rate on the full amount of capital gain, but rather on 50% of that gain. So it's quite a good concession that are currently in play. As a distinction, we're seeing more and more clients choosing to acquire property through a trust structure. And with the trust structure, there's multiple trusts available out there. I'll just focus on discretionary, or otherwise known as family trusts, which allows a trust to acquire a property for asset protection purposes, and along the way we get tax efficiencies based if that property is cash flow positive, and that is you're earning more income than all your interest and your expenses. If your interest and your expenses are higher than your income, you've made a loss on that property. Unfortunately, within a discretionary trust setup, you are not able to absorb those losses in your personal names, but they get quarantined for future income or capital gain, whatever that may be. An interesting thing that I always come across is I'd like to understand how banks view discretionary trusts and borrowing arrangements for your clients in general.
Okay, I'll give an example. If there was a family that owned an investment property and they held that in a trust, and then they decided, let's say they had a $500,000 loan against an investment property in that trust, and they were looking at selling their own occupied home to get a different property and upgrade. A bank would potentially discount the debt that's in that trust and hive it off when it comes to assessing the ability to finance and their borrowing capacity for their next property purchase in their individual names. So if they were selling their house and let's say they had $1 million debt and they had $500,000 mortgage on an investment property that was held in a trust, and they sold their property and they wanted to go and buy a $2 million property and raise more money, we could assess them on their individual level and exclude the trust debt from that servicing. So in a way, it increases their ability to borrow simply by having that investment property held in a trust.
Okay, so there's good commercial reasons why you would acquire property, especially an investment property, in a trust environment. for
And,
those
and it
reasons.
works the other way. Let's say someone was wanting to buy investment properties and have not just one, but go on a accumulation of 2 or 3 or 4 investment properties. They could potentially buy the first one in a trust, and then when they've got enough equity or saved up enough to buy the next property, we could then exclude that first trust debt from their ability to finance the next property purchase, which could be in another trust. And so, in a way, you're preserving their ability to their borrowing capacity simply by owning those properties in trust as opposed to their individual names.
Okay, so there's very good financing benefits.
There is, yes.
Yeah, so I guess every client should think about and assess their own situation and their sort of circumstances and what is the best mechanism to buy real property or real investment property, for not only for tax and asset protection purposes, but for financing purposes.
That's right. Look, I've actually got a client that I'm working on now who's buying his 6th investment property in a trust. And we did a little bit of restructuring for him to remove his owner-occupied property that was cross-collateralized into some of the properties he already owned. And we're now recommending to him to buy the next one in a trust as opposed to his personal names. And he loves that. We're into his 2nd property now, and he's now ready to buy his 3rd. But we were able to help him with his borrowing capacity purely because we had the 1st and 2nd investment property in a trust.
And I think that's why it's important an accountant and a finance broker should work together in building the best solution for any client that's looking to acquire any investment property in the future.
Absolutely, because from an accounting perspective, we need
We've got all the tax implications and the land tax and what's
Exactly.
best for what the client. And from the finance broking perspective, you can achieve the best result possible for the client.
Exactly. Well, Rick, I'd like to thank you for your time today and for explaining the accounting side and the tax side. And we look forward to a next session, which we'll find the topic and we'll post that up soon. Thank you.
Thank you.